Hey, it's Nolan Mathias from Mortgage 360, and today we are discussing CMHC's prediction that housing prices are going to fall by 18%. But before we get into it, do me that favor, hit the subscribe button, hit that notification bell, and please hit that like button so as many people can see this as possible, because the YouTube algorithm, it likes that like button. So let's get into it. Let's talk about CMHC's prediction that housing prices are going to go down by 18%. Now, it's actually 9 to 18% depending on the market. But I think before we get into exactly what the prediction is and why it may not be exactly correct, we need to discuss why CMHC is more likely to make a negative prediction than a positive one. And that has to do with risk management. So the economists at CMHC, their primary job is, one, to forecast the market, but two, is to make sure that they are prepared for the eventuality of some sort of market crash, so that if there's a mass amount of payout penalty or a mass amount of insurance payouts, that they're going to be able to survive through those payouts. So they're obviously going to predict a little bit more negatively so that they are prepared for the worst case scenario. That's their motivation, because their job is to be prepared for the worst. So good for them. They're doing that and making sure that they are making predictions that are on the conservative side. Now, here's what's wrong with it, though, because what they're doing is they're using average purchase price. And the problem with average purchase price is it takes into account every single property and every single price range. And what happens is when the economy contracts, usually the market that is the most affected is the high-end market. So the $2, the $3, the $4 million homes. They sell way less of them because, a CEO of a company, it doesn't look real great if, when the economy's bad, if he's going out and buying a $3 or $4 million home, right? So the sales in those markets tend to go down. And as a result, what that does is it skews the average price down, where, the activity in the lower price market, the $400,000 or $500,000 price range, may not be in as dire straits as it is in the high-end price range. We hear this all the time from high-end realtors. When the market gets bad, it gets really tough for them. Yet for realtors who are dealing with first-time home buyers, they can be having their best years ever. So, that high-end market really affects the average price point. And there's a lot of different economists and a lot of different organizations that are arguing that CMHC should be using something like the TerraNet price index, which basically is a mid-level home that is standardized. It's 2-3 bedrooms, whatever it is. And it's basically a benchmark style of home. And they look at the value of that property. And when they use that type of property in order to predict what's going to happen in the market, they're seeing substantially less declines. So they're seeing potential declines of between 0 and 10%, depending on the market. Here in Calgary, it's about a 3% decline that's expected. And it's a much more accurate way of predicting what the market's going to do, because it is a much more normal property. It's the type of property that's being sold the most. It's in that $400,000 or $500,000 range in Calgary. In other markets, it may be in $700,000-$800,000 range, but it's more accurate, and it is just a better way of predicting what's going to happen with prices. And what's important to note is that when you're looking at economic data, you have to look at the source. Because for an organization like CMHC, they're going to have a negative outlook. For an organization like, the Calgary Real Estate Board or the Toronto Real Estate Board or CREA, they're probably going to have a more rose-colored glass when they're looking at the market, and they're probably going to predict higher numbers, probably too high. So what's the reality of the Canadian market? It's probably somewhere in the middle. With this whole pandemic thing, what we're seeing that there's less supply because people don't want people coming through their houses to view them. So they're just saying, I'm going to stay put. I don't need to move. I'm not going to move. So less supply, but there's still lots of demand. In fact, what we're seeing a lot of first-time home buyers who are saying, holy crap, I've been locked up with my parents for 3 months. I need to get the heck out. And then they're going out and, maybe they don't qualify. Maybe they do. If they don't, their parents are saying, well, hold on a second. We're tired of being locked up with our kids. We want them the heck out. We'll co-sign for them. And what this is doing is it's creating more buyers than there are sellers. And that's actually creating positive pressure on prices in the market. And because when you take a lot of the supply out and you increase the demand, that's what increases prices. So as of right now, as of today, what we're seeing in the market is we're seeing that prices are fairly stable because of that lack of supply and that higher demand. And I suspect that that is going to be a continued trend until we see how this whole pandemic thing plays out. And ultimately, is the economy going to slow? Yes. Ultimately, is there going to be some downward pressure on prices? Maybe. But at the end of the day, what it all comes down to is how much supply is going to be available. And I think what we're going to see is we're going to see less housing starts, which means less supply. We could see people start moving into Canada as different markets start to look outside of the country for experienced and technologically savvy employees. So we could see net migration start to increase again. And with the lower supply, we could actually see a market where housing prices continue to increase. So do I think you should panic and sell your house because values are going to go down? No. Do I think you should wait to get into the market because values are going to go down? No, because what could end up happening is you could miss out on the market, or you could just have to buy 2 years later and end up having taking 2 years longer to pay off that house. And instead of having the house paid off at 55, you pay it off at 57, which affects when you can retire and all of those things. I think at the end of the day, if you need to sell your house, sell it. If you need to buy your house, buy it. Don't be a speculator. Don't be somebody who's trying to figure out what the market's going to do, because speculators lose. It's just, that's the way it works. Nobody can predict the market, but do what's right for you right now. And when it comes to predictions, make sure you look at the source, make sure you look at other sources, and try to find where the middle ground is, because more than likely, that's about what's going to happen. So that's what I got for you today. Again, if you like this video, hit that subscribe button, hit the notification bell, and please, please, please hit the like button to make sure as many people as possible can see this. Cheers. We'll see you on the next one.